To take us through current valuations alongside expectations for earnings and dividends, Bogdan from Blackmore Capital joins us. Marcus, good to talk.
Good morning, Nadine and Andrew. Thanks for having me on.
Wonderful.
Yeah. So obviously seeing what's going on in the States at the moment, mostly beating expectations there. How are you looking locally just ahead of earnings?
Well, I think Australia, we're still in an incredibly privileged position. We're seeing much better economic activity at a macro level, and then we're in an upscale in terms of the earnings cycle as well, and we're seeing a number of upgrades coming. It'll be pivotal to see what happens in the first half results season, but so far in Australia, which is in sharp contrast of what we're seeing in the Northern Hemisphere, it looks particularly encouraging.
Looking in terms of dividend growth in particular, I'm just curious to get some of the main thematics that will be coming from this reporting season. Dividends obviously took a hit last time around. Many were cut or deferred. What will be the narrative there?
Well, I do think we've seen a trough in dividends, and the dividend yield for the overall market is about 3.4% forecast, which is well below the historical average of around 4%. And so I think with greater confidence in a range of different sectors, I think you'll see dividends starting to come back, and particularly in the banking sector, not only with CBA, but later on with the other banks, a restoration to more sort of normalised levels.
Do you think we'll get more certainty as far as guidance is concerned? Obviously, that's been lacking over the past 12 months for obvious reasons, given the greater uncertainty of the pandemic. But we're still, even in Australia, even though we sort of appear to be on top of outbreaks, there's a sense that they will perhaps continue to cycle through and will go in and out of lockdowns until the vaccines are well and truly rolled out. So what risks are you seeing there?
Well, I think you're absolutely right. I mean, the pandemic is offering a whole range of uncertainties, and we're seeing that in the issues around distribution. We're seeing new cases, we're seeing new variants. All those risks are what the economy and companies have got to grapple with. But I think we've got a level of surety which is greater in Australia, particularly in certain industries, in consumer staples and industrial companies, and we're on that pathway to recovery. But as your previous speaker said, I mean, there will be definitely bumps along the road, and I think we're seeing that with some retracement in markets today.
Yeah, Marcus, to that point, so the worst session in about 3 months in the US, following on from a pretty dismal session here in Australia yesterday. So what else could derail some of the momentum that we have seen as of late when it comes to the local market? Because again, previous guests saying really all roads lead to the bond market, and we are watching bond yields rising. Is that a key risk in your view?
Yes, it is. I mean, we've got to be incredibly mindful of bond yields because they've been so supportive of growth assets for such a long time. And hence, I think it is a better tilt at the moment to be still defensive, to still be on that value and cyclical play, which will give you a bit of greater protection around rising bond yields. And also, obviously, if there's any hiccups in the pandemic here and any sort of further lockdowns. But notwithstanding that, I mean, I think policy support remains incredibly accommodative.
Yes, so Marcus, just on that front then, which sectors are you feeling most comfortable with as far as portfolio allocation is concerned? And you obviously mentioned the financials there, and as far as dividends are concerned, what else are you looking at?
Sure. I think what we're seeing in the bifurcation in the world is that our focus is more so on the domestic earners, what's happening in the Australian economy, and what companies are benefiting from that. And so in healthcare, it's companies like Helios and Medibank, which I think will be a beneficiary of greater growth in private health insurance and in financials in the banking sector, which has underperformed every year since 2015. We're seeing for the first time both the prospect of earnings and dividend growth with a focus on Australia and on a focus on a recovery in our housing market. So they'd be sort of two areas that I would continue to focus on. And I think, supermarkets, consumer staples will continue to do well as people still stay primarily at home.
Can I just pick you up on healthcare there? You mentioned the greater growth in private health insurance. Is there actually evidence that that is likely to happen, particularly as we're seeing millennials drop out or completely, feel as though it's simply there's no benefit of them being there? What growth are you seeing there?
Well, the numbers actually have shown that there's been better policy growth, particularly with Medibank. They've taken market share, and they were initially expecting policy growth of around 1%. They're forecasting 2.8%. And then on top of that, we're seeing premium rate increases being brought back into the market on the 1st of April, and Medibank are being able to raise their prices by 3.25% then. So it's a combination of both policy growth, price increases, and you're absolutely right, there is a sensitivity around that, but also more broadly at an industry level, I do think one of the beneficiaries of COVID will be private health insurance. The focus on health, the fact that waiting lists in public hospitals are ballooning out, and that patients are needing to use the private health insurance to get that elective surgery done. So at an industry level, I think there's some strong underpinnings there as well.
So you are favoring value in cyclical sectors over growth on all of that. I'm curious as well to just, if you could walk us through your view on how much of a portfolio ideally should be pretty defensively placed, because you do have some really defensive sounding names in there.
Sure. Yeah. No. We divide the portfolio up into sort of three factors. Quality, which are those defensive names such as the supermarkets and really good industrial companies. Cyclical and value, and growth. We've been reducing our exposure to growth to less than 10% in the portfolio, when we've really moved up our exposure to value and cyclicals to around 25% of the portfolio. And then the balance is, as you rightly point out, is in those sort of defensive, really good quality names.
Just a final thought, Marcus, on the discretionary retailers, because we have had a number of them coming out ahead of reporting season, upgrading the expectations. We've had a lot of stimulus. As you well know, we've had super being accessed. And we also have a lot of home building, a lot of home renovation going on. So could we see the enthusiasm for some of these names continuing perhaps longer than we had originally anticipated? Because, of course, we've also seen this paradigm shift to e-commerce, to online shopping. Just want to get your view ahead of reporting season on the discretionary retailers.
Yeah, I think they will report strongly. And the fact that there's so many Australians have stayed in the home economy, they're at home, they're not spending more on services, they're spending on goods. And I think that trend will continue. And those discretionary retailers, whether elements in Wesfarmers or in Premier or in other groups, they've been very successful in expanding into omni-channel areas of growth. And I think those trends will continue. They'll benefit from the physical footprint and the return to shops, but also they'll have the other benefit of also being able to deliver more effectively online.